Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Last week, only one matter preoccupied the mind of investors, and that was inflation. In particular, the U.S. April inflation number stunned investors. At more than 4%, inflation is rising at the fastest rate in a decade. Could this be a turning point in markets? More importantly, will the Fed sustain its monetary largesse as inflation spikes? At $120 billion per month, it will not take much for the Fed to trim this number and reduce quantitative easing. This will dampen risk-taking substantially. After all, the current Fed chair had raised the Fed fund rate from 1.75% to 2.5% in the early months of his tenure. So he's not averse to tighter monetary policy. But will the Fed do it? Right now, the Fed sees the inflation surge as somewhat transitory. In fact, the Fed thinks that the growth-led inflation is good because it reflects a normalizing economy backed by rising aggregate demand. What surprises us is that the market finds the recent inflation surge unexpected. The evidence was there if anyone cared to search. Look at copper prices. Its uptrend is the strongest in years. Look at shipping rates. Look at agriculture prices like soybean. Prices are surging like 2007. Look at the acute shortage in computer chips. Most basic commodities are more expensive now than they were a few months ago. So the market can't say the surge in inflation came from nowhere. What has changed? We suspect April's large inflation number has to be contextualized against the unfolding situation in Asia. The new COVID variant in India has completely swamped the country. The highly infectious virus is spreading rapidly and is causing several ASEAN countries, such as Malaysia and Singapore, to lock down again. Even Taiwan, a rare pandemic success story thus far, is reporting a surge in COVID cases. This may precipitate a supply shock to the country's electronics sector. Manufacturing bottlenecks in these countries may result in higher goods shortages as regional trade slows. And should the spread of the Indian variant accelerate, the shock to the global supply chain could last well into the second half of 2021. This supply pinch is inopportune because many Western nations are about to reopen again. The UK, for instance, is loosening its social restrictions this month. And the US, after a massive vaccination drive, is eyeing a further relaxation of social distancing rules, including ditching masks for fully vaccinated people. A surge in Western demand, coupled with a lockdown in several Asian countries, are causing investors to cast doubt on the thesis that recent inflation spikes are transitory. This brings us to one point: is gold a good trade amidst this environment? Since peaking in August last year at $2,075, gold has been stuck in the doldrums. Prices recently touched $1,675, a drop of nearly 20%. But a recovery is taking place. Prices have rallied above $1,800 and appeared to be heading back into $1,900. Should inflation stay up, gold may retest its all-time high. There is another related commodity on this inflation trade: silver. This metal, dubbed the poor man's gold, also soared last year alongside gold. But it did not surpass its all-time high at $50. Prices peaked at $30. Strong technical support is noted at around $22 and rising. Should gold break into record highs, silver could well rally above the $30 resistance and retest its $50 peak established a decade ago. Another reason to buy gold and silver is to protect against a stock market correction. A higher inflation may lead to a reduction in quantitative easing and higher borrowing costs. The latter reduces leverage, which tends to drive stock prices lower. These metals are safe haven assets, which tend to do better when risk sentiment deteriorates. The ETFs relevant for the trade are SPDR Gold Trust, ticker GLD, and iShares Silver, ticker SLV, both of which have seen heightened interest amongst institutional investors on Trackstar IQ, our proprietary search tracking tool. Of course, many argued that the crypto coin Bitcoin is also an inflation hedge asset, primarily due to its limited supply at 21 million units. But given that Bitcoin has only been in existence since 2010, its performance during a period of high inflation is not tested. In summary, markets are entering a period of increased uncertainty as some economies are reopening and some are locking down. The supply of goods was severely disrupted over the past year. This is set to continue into the second half of 2021. More likely than not, inflation will continue to stay on the higher side. This provides the case for some inflation-related trades such as long gold and silver. However, these inflationary factors could be only temporary, as expected by the Fed. Lockdowns tend to reduce demand, and this may help to equilibrate supply and demand, especially as more Asian countries tighten social distancing rules. Therefore, this inflation trade is only a trade. Risk parameters must be respected. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.